Hi, my name is Tom Lee, Chief Investment Officer at Parametric. Today I'm going to provide you with our investment outlook, first by looking back at some key events of 2022, and then considering how they may evolve into 2023. For investors, 2022 has been a painful year, likely one they'll want to forget soon. Most domestic equity benchmarks are down between 15 and 20% year to date, while foreign equity benchmarks are off by more than 20% year to date. Fixed income has provided no protection from this storm, with common benchmarks down between 8 and 12% year to date, depending on the duration characteristics of that benchmark. Commodities have been the one lone bright spot among all asset classes, up almost 16% year to date. What 2022 has been good for is tax loss harvesting. That's selling securities at a loss, realizing that loss, and using it to offset gains either in that year or rolling forward to a future year. What has caused this outcome? Aggressive Fed action to combat inflationary pressure has been the primary contributor to returns. Rising rates and flipping from quantitative easing to quantitative tightening. Interest rates are now up across the yield curve, and the curve is now inverted, with 2-year treasuries trading at a higher yield than 10-year treasuries. A signal of economic weakness in our future. The Fed's actions are having the desired effect. We're seeing the slowing of economic activity and the reduction in inflationary pressures. We see a fall off in the year-over-year growth of monetary aggregates like M2, and asset prices, both financial and real, like real estate, are down. And finally, we're starting to see an uptick in unemployment, with lots of companies announcing layoffs, particularly in the once hot tech sector. Ultimately, the market is betting that the Fed will gain the upper hand in the battle with inflation. Both 5-year and 10-year break-even rates, or the rate of inflation embedded in TIPS securities, are trading near 2.3% or very near the Fed's target of 2%. But until that outcome is more assured, it's likely that financial markets will remain more volatile. What do we expect in 2023? Investors need to look at the silver lining present in the bear market of 2022. Stocks and bonds are cheaper than they've been in a while. Let's take an example from the municipal bond market. If you're married and filing jointly living in California, at the beginning of this year, you could purchase a 5 to 15-year double-exempt muni ladder with a tax equivalent yield of 2.96%. That same ladder now trades at a tax equivalent yield of 7.10%, or fully 4.14% higher. You need to go back before the global financial crisis to see rates at these levels. A similar story exists in equities. Based on forward price to earnings estimates, stocks are much less expensive than they were just 1 year ago, particularly international developed and emerging markets. Does that mean stocks can't come even cheaper? No, we could see earnings estimates decline or price to earnings ratios decline. It simply means that investors have the opportunity to buy earnings at a lower price point than they did previously. By all measures, 2022 was a difficult year for investors. The Fed made certain of that with its actions. However, the broad sell-off in the markets has created opportunities for investors to consider as we head into 2023. For more from Parametric, click the link at the end of this video.